This is Better System Trader, episode 13.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to Better System Trader, episode 13. I'm your host, Andrew Swanscott. This week's guest is a hedge fund manager who specializes in developing and trading quantitative strategies across all asset classes. Before joining the hedge fund world by establishing his own hedge fund, he managed global head positions at Reuters and Equities International. He's the author of two books, the first being international bestseller Following the Trend, and the second, Stocks on the Move, which has just been released. In this episode, we talk about trend following in stocks, why traditional approaches don't work and the solution to account for this. We also talk about trading concepts, cash versus risk allocation, position balancing, and building robust strategies. This week's guest is Andreas Clenow. Hope you enjoy it. Hi Andreas, thanks for joining us today.
Thanks for having me, Andrew.
If you can please just start by providing us a bit of information on your background and how you got into trading.
Well, long story. I started out in Sweden a long time ago. I'm originally from Sweden, living in Zurich, Switzerland at this point. I think what's unusual about my background is that I was to begin with a hobby trader when I was in university, which might sound odd, but that's actually unusual in the business. Most people in my side of the business are not from the hobby trading background, so that's. I have that perspective to begin with. I started out back in the 90s, trading the tech stocks, of course, in the bubble, all of these things, building trading models, technical analysis systems, all of these things. In retrospect, very, very basic and probably not the best things. Actually, for sure, not the best things. Probably pretty crappy things, but gotta start out somewhere. I was building the usual kind of simple trading models and Metastock or whatever else the programs back then were. I was in IT for a while back in the 90s. Started an IT company back then, so I had a bit of a tech background from there while I was studying finance. I did a brief stint as a finance consultant, a financial consultant in Stockholm. Then moving to Geneva, over in Geneva, I had a team of financial quants working for me, building financial quant models, calculation models, these kind of things. I left that about 10, 15 years ago, something like that, mostly because it started getting a bit too corporate for my taste. As usual, you move up the ladder, you spend more time in teleconferences fighting for headcounts instead of actually doing something real for a living, and it's not really what I wanted to do the next 40 years or so. I left that whole thing some decade plus ago, and I was lucky enough to run into people who had capital. They needed to invest. They wanted to build a trading strategy. They wanted to start something, start an enterprise, start a new hedge fund shop, and they had enough capital to do it, but they lacked the technical skills and the trading background, the quant background, and that's where I came in. And we started a shop back then. I was running that shop for some years before divesting my part and joining ACIS, where I'm now the chief investment officer. So I've been in many different places. I've been in the pure tech, the IT back in the 90s. I've done the quant modeling. I've been managing quants. I've been building things. Started a couple of hedge funds, and now I am overseeing the investments for ACIS in all asset classes, all styles, and we do a lot of things. So I've got a broad background.
So when you actually started trading, did you initially start with quant or mechanical based strategies?
More or less. I would say back in the 90s, as most people when you start out, you don't really know where you're heading. You're trying everything, right? I read the usual technical analysis books. I tried the usual systems. I did the usual mistakes. I've gone through the same cycle as most people on that side. I was building a lot of systems. I was trying to build my own backtesting platform back then, which well, in retrospect, was not a great idea. But anyway, it was. I learned a lot from it. I think I have some memories about building a point and figure plotter and adding indicators on some automatic point and figure system. And I don't know what I spent my time on, but it was a good learning experience anyway.
Yeah, cool. All right. Well, thanks for giving us a little bit of your background there. So I'd just like to start with a post that you published on your website. I think it was probably about a year ago now. Mm-hmm. It had a rather provocative title, and I think it may have actually led to you writing your new book, which we'll get to soon. The blog post was titled "Trend Following Does Not Work on Stocks." Why did you say that?
Well, it's a long story, but briefly, I had said something in some interview about the trend following must be done differently on stocks compared to futures. This resulted in, well, people misunderstood it, and I started getting some emails about people talking about that I had no idea what I'm saying, because apparently I've said the trend following doesn't work on stocks. I thought it was a bit funny because I had never actually said that, not yet anyway. So I figured, well, they have a point. It doesn't really, strictly speaking. I mean, it's a matter of splitting hairs here. It's a matter of what is the difference really between momentum and trend. But since apparently a lot of people misunderstood something I said in an interview somewhere, I thought, well, okay, let's explain it. Let's explain properly what I'm actually meaning with this. In my view, trend following doesn't work on stocks. It's a very different thing. I mean, you can't just take a trend model built for diversified futures trading, which, well, trend following is, and just apply it on stocks. It just doesn't work that way. It's very easy to prove that. You take any form of any basic trend model and put it on run on stocks, and you will have a horrible performance. So I just tried to be clear, explain the difference, and the title, well, it got you to click on the link, didn't it?
Yep, that's right, and a lot of other people as well, I'm sure.
Yeah, I mean, the problem is trend following originated in futures world. For trend following, well, most people know the background of trend following, right? It started back in the 70s, 80s, depending on how you look at it. It's a matter of buying something that starts moving up or going short something that starts moving down. You put a trailing stop behind it, and that's pretty much the strategy, right? If you run that on one single market, you're very likely to lose. Trend following is depending on massive diversification between markets. There's a reason professional trend followers apply this on a broad set of markets in many different asset classes, many different areas, often many different time frames. Nowadays we diversify with different styles and models. It's all about the fact that most of the time you lose. Some positions gain a lot, most positions lose a little bit. Some markets keep losing year after year. You still trade them because you don't know which market is going to gain next year and which one is going to lose next year. But you apply trend model to one market or a set of very correlated markets, and it's very luck dependent. It might work, it might fail completely. It's luck dependent. You apply it to the right type of market for that particular asset class, and you might do fine. Now the problem is for stocks, well, you don't have any diversification. You have very tiny diversification in a way. Mm-hmm. If you trade, for instance, say oil equity markets, the short-term interest rate markets, and a couple of currencies, they don't have very high correlation. Even something like soybeans and feeder cattle that has very low correlation to each other. So it's not very likely that you gain and lose at the same time with these two markets. With stocks, well, they will always be very correlated. It's a very different game. You can't just apply standard trend following model. You have to take this into account that the stocks are very different. They behave very differently, and they behave very much the same. You always have a huge beta component. So I tried to explain a little bit. I mean, for instance, there's a couple of major points that are different here. You need to take into account the overall market state. You can't trade the same whether the index is going up or down. Normal trend following, you have no such factor to care about. Then it's a matter of what do you trade. And in futures world, you can trade everything. You can throw in 100 futures contracts in there. There's no problem. In stocks world, well, do you pick manually the stocks first? And in that case, is it really trend following or just buying the stocks you like? If you don't pick the stocks manually, then how do you pick them? You need some form of ranking mechanism. So there's so many different things when you start digging into the details that will be different with stocks. That's why I try to highlight the difference. What is the difference between a professional momentum style strategy and trend following?
So isn't that just a case of semantics though? I mean, doesn't trend following and momentum really mean the same thing?
Not really. I know there are industry people who know what they're talking about, who might disagree on that point, and that's just fine. Part of it is semantics. You could say trend following. The problem is it might be confusing because people believe it is the same then. I use different terminology to highlight that you have to do it very differently. Now, I mean, if you redefine trend following to mean buy and hold anything that goes up, well, then everything is trend following, right? What I do with the momentum strategies is much more complex. I try to identify which stocks are moving up the most, which ones have the best profile and in terms of vol adjusted momentum. It's very different from trend following to begin with. They automatically build portfolios based on these best stocks. That is, you keep rotating stocks, you keep moving out of stocks that are not performing among the best stocks anymore, and you move into the best ones. That also means that even if a stock keeps moving up, you go out of it, move into something that's moving up more. And it's also a key difference compared to normal trend following, where you would just stay in until you hit the stop, right? Stop loss points might not make that much sense either with stocks per se. Some people use them, some people don't. I show in the models I present in the book that you don't have to have them. I have no stop point at all in the book model.
So what you're really talking about there is the implementation side of trend following versus momentum rather than conceptually.
Well, I mean, you can still buy things that move up and hold them when they move up, but it's still a different thing, right? I mean, if you apply trend following model, you're in it for as long as it moves up, right? But the stock can keep moving up, but it's moving up less than other stocks. You still stay in it or not? Or how do you identify that this stock is not performing as well as another stock? And maybe your stock is gaining, but you could gain much more somewhere else. Maybe you're underperforming the market, but you're still gaining. It's a much more complex strategy than trend following. It's much more complex in modeling, I should say. Implementation might not be so much more complicated.
Well, that leads nicely actually into your new book, Stocks on the Move, where you outline a strategy for trend following or momentum in stocks. It's a great book, so I highly recommend everyone go out and check it out. But I'd just like to discuss a couple of concepts in there that I found interesting. Mm-hmm. The first one, position sizing. So in the position sizing chapter, you say it's a bad idea to think in terms of cash allocation. Can you explain what you mean by that and why it's a bad idea?
Well, I mean, the lazy way to allocate capital or to allocate position size would be to say, well, I want 20 stocks in my portfolio, I'm going to buy 5% each. Well, why would you pick that number? What if one of the stocks is a highly volatile biotech that tends to move 4 or 5% a day, and another stock is some utility that moves 0.5% a day? Why would you allocate the same capital to both of them? Doesn't really make any sense to me. Suddenly, your whole portfolio risk would then be skewed towards the volatile issues. Your risk allocation would really be random, right? If you happen to pick a volatile stock and you always allocate the same amount of capital, you're taking much more risk in the volatile stock. Is that really what you want to accomplish? That's my point. What I'm doing instead is I measure volatility on each stock and allocate according to volatility. That is, I'm trying to get the same approximate risk per investment, not the same cash. Who cares about how much cash you're spending on the stock, right? Cash is not risk here. This, of course, I have to say, is nothing unique. What I'm saying here is industry practice. This is common.
So as the volatility changes over time, how do you account for that if you're actually in a trade at the time?
I do frequent rebalancing. That is, if volatility goes up or down, if it's tiny, then probably it doesn't matter, and you need to have some sort of filter, of course, so you don't keep over trading and adjusting too much. But if volatility that makes major changes over time, you need to change your position allocation.
So if you're rebalancing your positions, how often should you do that? What factors do you need to consider when you're looking at a time frame?
Well, first it depends on what you want to accomplish, of course. More importantly, you have to look at what are your trading costs. Trading costs might be very different depending on, well, who you are, how big your portfolio is, and what kind of markets you trade. If you're institutional and trade the US markets, trading costs are tiny. You can rebalance quite a lot. In the book, I use I think I use 2 weeks. I had to think about it. I think I do every 2 weeks. I do a position rebalancing. So I check the sizes. I believe I have a threshold of. I should remember my own book, shouldn't I?
5%, I think.
5%. Thank you. So basically, if the position size doesn't change more than that, then let's not care. This could be raised. This is something that people can play around with to match their own, what works best with their own, whether the kind of structure they're working with, the costs, and also for some people there might be a tax implication in doing this too often. So it's something you need to look at. But some sort of position rebalancing makes sense in long-term strategies.
Okay, so you've kind of touched on this a little bit, but you've talked about risk allocation and position rebalancing as practices common in the institutional world, but perhaps not so much for by retail investors or traders. What other practices can you think of that are in the same kind of category?
Well, there's a lot of differences that I see between what we tend to do on the hedge fund side and institutional side compared to a lot of things I read about, a lot of methods, especially on the position sizing side, and the risk side can be quite funny. Actually, the differences at times. I think in general, people think hedge funds take a lot of risks. Well, what I see from the retail community, we don't take that much risk in comparison. We aim for much lower returns, I would say, than a lot of what I read about that retail traders use, the kind of methods. There's a lot of odd things in position sizing I see quite often. You might have seen I've written a little bit about that as well, and I think that was also seen as a bit more provocative than I had thought. Things like position pyramiding and this kind of things that doesn't really make any sense at all to me. There are a lot of the things that I see more as gambling than any sort of professional trading. I mean, the idea, for instance, of taking a position and then it goes a bit in your favor and you double the position because now you're playing with the bank's money. It's a little bit of Las Vegas kind of logic, and it's not really what we do on the other side of the business. I mean, the probabilities doesn't really change, right? Say you buy at 100, it goes up to 120, and now you double your risk. Well, did your probabilities somehow change because you now have a gain in the position? I mean, the basis for the trade hasn't really changed. It's not like you have a higher probability of future gains now, right? So increasing risks all of a sudden just because you entered previously, that doesn't make any sense.
Right. So just a little bit more on this position sizing. If you're actually taking smaller trades because the volatility of a stock is higher, does that indicate that generally the returns will be lower?
You mean on a stock level or on a portfolio level?
Well, I guess at a portfolio level.
Well, it depends on how much you allocate, right? In the strategy of in the book here, we always use all the cash. So you could argue, of course, quite validly, quite valid argument would be that the portfolio level risk here is random, not the position risk. And that's fair enough. You always have to simplify some things, right? But yes, of course, if you take a smaller, if you have high volatility, you take a smaller position size. Well, you get lower both risk, lower possible losses or gains than if you take a larger size. But the idea is that every position should have an equal risk contribution to the portfolio. So every position should have an equal chance to impact up or down the portfolio. That's why you do the volatility-based sizing.
Right, okay. Okay, thanks for answering that. So I'd just like to jump to another section of your book, which I thought was fantastic. It's something that I've never seen in any other trading book before, and that was the year-by-year review. So I know that a lot of other people have found that to be the highlight of the book. I'd just like to ask you, when you did that exercise, what was the biggest insight or benefit that you personally received from doing that?
Well, I started doing this. I did this in my first book, following the trend back in 2012. My thought with doing this was that when you just see a simulation of just a long-term simulation, just the results, a monthly table or an equity curve, you don't really get a feeling for what it's like to trade this. It's very easy to look back at something and you say that, well, this dip by 20% over there, that's fine, right? Because we recovered that in half a year. But that's not really how it works when you're sitting there and you're trading $40 million on this model, and suddenly you see millions and millions gone from the account. You have people calling, you have word investors. It might be completely according to simulation, but when it actually happens, it's a whole different story. What I tried to do here was bring some realism into the whole thing. I tried to explain the difficulties. That was the main reason that I did this chapter. When I did it first in the first book, I was quite worried that people would see it as a page filler, something I did to fill out 1/3 of the book. It did end up to be a third of the book. No, I was quite relieved that I never got that feedback at all. So I tried to bring in some sort of, well, my own experiences. What's it like to say the first book, for instance? What's it like to be fully loaded in energy, and suddenly there's a massive increase in margins, and your long heating oil and makes a 9% drop in a day. It's not very fun. You're fully loaded in stocks. Suddenly there's a tsunami and a nuclear accident in Japan, and if you take a 20-30% hit, that's pretty tough things. Even if you can see a simulation that you're back on track after half a year, when that happens, well, that's a whole different thing. This is as well why I'm keeping risk levels on these kind of things are, I would say, more realistic, more normal, something that you can actually handle. That means aiming for reasonable returns, not for this triple-digit fantasy returns which too often see in simulated results.
Yeah, I think as well, as you mentioned, it's easy to look at a simulated equity curve and say, oh, it had a dip in 2008, or it was flat for a year and a half, and oh, that's easy, I can trade that. But when you're actually living in that moment, it's a very, very different story. So I think that's probably one of the reasons why everyone loves the year-by-year review in your books, is because it really highlights those moments as you're trading through times. You've already touched on some of the challenges in following a long-term strategy. Are there any others that you can think of?
Well, in reality, there are usually so many more factors to consider. I mean, the first thing is, of course, you have to keep the risks much lower than most of these simulated results I see in websites, books. I see often things that would be very difficult to implement in reality. But the other thing is, of course, during this time, it depends if you're managing your own money or others as well, but if you're managing other people's money, then you have the flows to care about, inflows, outflows, which tend to be at the worst possible time on both directions, of course. Once you had you make a big gain, suddenly people put a lot of money with you. Next, of course, you have a big loss, people take it out. They're quite upset because, well, they made a bad trade, right? And then you have a good run again, and people come back with money at the top, and this cycle tends to continue. There are a lot of these kind of things. That, of course, leads to some practical issues as well. You might get a note from your administrator that we need $3 million by tomorrow to take out for client redemptions. Well, you got to free it up, right? These kind of things, it's not just practical, but it might impact performance as well. There are a lot of these kind of things that are not visible in back-tested results.
Yeah, right. Okay.
Of course, if you have, depending on how your clients look as well, I mean, you might have major clients who have enough cash to have to put pressure on strategies and change the strategies and these kind of things. And reality is different from a backtest. If you have a client who's got 80% who controls 80% of the money in a product, and they're pressuring to change something, well, you might have to, even if it's the wrong decision at the wrong time. So reality tends to be a little bit different from the backtest. It's pretty much the point I'm trying to make.
Yeah, right. Okay, well, just before we move on to some questions by the listeners, I'd just like to ask you about a section towards the end of your book, and it's called A Random Kicking of Wall Street. And basically, you highlight that the majority of mutual funds out there fail to beat the index. How hard is it really to beat the index if these professionals struggle to do it?
Well, first you have to understand the structure of mutual funds. It's not really their fault. Yeah, most mutual funds fail to beat the benchmark. Actually, an overwhelming majority, something like 85% on average, of mutual funds fail to beat the benchmark. It's not really their fault. You can't say that the mutual fund manager is stupid or incompetent because he didn't beat the benchmark. The odds are stacked against him. He doesn't have much freedom. You have a minor tracking error budget. You have to be more or less invested in line with the index. You have a very tiny part you can play around with, and for that you need to pay for the cost of the fund. It's not really a structure that's built for beating the index. The whole structure goes against you there. So it's a systematic problem with that business. So beating mutual funds is very, very easy. Buy an ETF tracker, you beat the mutual fund. If you want the index, buy a passive tracker. That's not so difficult. Now, I guess since you're asking about the random test in the chapter, the last chapter, that's more about beating the market by using an unconventional approach. This chapter was based on something that David Harding said once in an interview, that he pointed out that the S&P 500 is a trading system, like any other trading system, and it's a pretty poor trading system. It's a trading system in that it has rules for when to buy, when to sell, and how much to buy and sell. Now, following that system, the results are quite clear, right? You get what the index gives you. Total return index, that is, not the price index. It's an important point. Always look at the total return S&P index. That includes dividends, of course.
Sure.
Now, what he pointed out there was that you can pick 50 random stocks. Every month, start of every month, you pick 50 random stocks. Start of next month, you pick 50 new random stocks. You just buy 50 random stocks beginning of every month, you sell them and rebuy 50 new random stocks next month, and you beat the market. And he's right. What I showed there is it's a very simple simulation. I built a model that just picks 50 stocks beginning of each month, uses volatility parity sizing, holds them for a month, and replaces them with new ones. And I ran that a few hundred times. I think I show 50 of them in the book. Not a single of these few hundred iterations I did failed to beat the benchmark. All of them massively beat the market over time.
Yeah, I was quite amazed when I saw that.
Feel free to test it. It's an easy simulation to make.
What's the difference there? Is it the position sizing based on volatility that's making the big difference?
That makes one big difference, yes. I think I also showed that somewhere earlier in the book. If you, I did another simulation earlier in the book where I bought all the stocks, always have exactly the same stocks as the S&P 500, but at risk parity sizing, or to be technically correct, volatility parity sizing. I think I mixed up the concepts. I mixed the concepts in the book, but it's technically vola parity. So I buy all the stocks, 500 stocks, any given time. Change, of course, when the index change, but at equal risk, or equal vola. That also massively beats the index. But that's, of course, not a very practical way to trade, unless you're starting your own ETF. That might be a good idea for an ETF, but it's not so easy to implement that by yourself.
Yeah, that's interesting. I think that could be a good avenue to do some further research.
Mm-hmm.
So what do you think is the most important component of a trading strategy? I suppose that probably depends on the type of strategy, but as a general idea, do you think there's one particular component that's more important than another?
No, it's too hard to say. It depends very much on what type of strategy. I mean, it's easy to say something like the risk management or something, but it all depends on what you're really trying to achieve. I mean, keeping it realistic is the most important thing for me. I mean, trading a broad concept and not some over-optimized. I see too many trading system ideas that are based on take these 10 indicators and optimize all these parameters, find some amazing pattern where you buy and sell based on all these indicators, and those things are never stable. They're never robust over time. I would say look at very broad concepts. Start with a broad concept. Broad concept doesn't need to be over-optimized. I mean, trading momentum, for instance, or trend following for futures, those are very broad concepts. If you implement it in a simple way, it doesn't matter so much exactly how you do it, all the details. You're trading the broad concept, not the tiny details.
Yeah, that's another interesting point I found about your book is that you first go through some ideas on what you think, you'd like to get into a stock that behaves this way. You don't want it to gap up, have a large gap in the last X amount of days, and you actually go through the concepts before you start building a system, which I think is a good way to look at it rather than lumping a whole bunch of indicators together and seeing what sticks. It's a really good approach.
Yeah, I think it's important to start in a realistic angle. I mean, you start with coming up with what you want to trade. You can start with throwing a whole bunch of indicators on the wall and see what sticks. I mean, you're going to come up with something over-optimized that will not work in reality later on. If you don't know what you're trading and why, then probably it doesn't work.
Yeah, that's right. That's a great tip. Thanks. I'd just like to move on now to some listener questions. The first couple are from Michael. His first one is, when you're evaluating a system, what steps do you take to make sure the system is not curve fit and that the system is robust?
Well, that actually fits very well to what I was just saying, actually. Because I start out with a broad concept that I know or have seen, have experienced, works. It could be, for instance, something like momentum, the momentum effect in stocks. I figure out first what I want to do. Say I want to do medium-term momentum in this case, in the case with the book. Well, there's not so many different ways to do it. If you know what you want to capture and how, well, you can construct a strategy that does it. You pick the strategy parameters based on what makes sense. See if it works. Try a couple of different variations. Just see if it's robust. What if I tinker with some details? I wouldn't at all do an optimization to see, for instance, if a 90-day momentum measurement is better than a 87-day, or is it 123 days? Doesn't matter. If your strategy is depending on these kind of things, it's not going to work in reality. So you need to pick something that's broad, check that it's robust, and no optimization. Then it just leads to curve fitting.
Right, okay, thank you. And another question from Michael is, what is the one thing you wish you knew about system trading before you started developing trading systems?
Well, probably that I started out like everyone else, building one system for one market. And I see far too many people still trying to operate in this way, and it's not a realistic way to do things. You see too often you open a trading magazine or something and there is the new superweight trade NASDAQ, for instance. That's not really the way things work on my side of the fence. You need to start with a portfolio perspective. Position perspective doesn't matter. Any single position, who cares what happens to any single position? So the only thing that matters is your portfolio as a whole. I think that's the major difference between hobby traders developing trading systems and professionals. The portfolio thinking. I would say that's the key thing I would recommend that people starting out look at. Develop portfolio models and not position models.
I think a lot of people gravitate towards stocks initially because that's what they know. So when you say portfolio, does that include a selection of stocks, like in the S&P 500?
Yeah, exactly. I mean, if you talk about stocks, for instance, it doesn't matter, any single position you buy, it doesn't matter whether that gains or loses. All that matters is what happens to your portfolio as a whole. So that means you're starting in the wrong angle. If you start by picking a stock and then trying to develop a super trading model for this particular stock and time the entries and the exits, yeah, good luck. I mean, some people can do it, but it's not something I would recommend. Try instead to build something where you're constructing proper portfolios, and hopefully without your bias, or everyone has a bias about certain stocks. You shouldn't go buy Apple because you like iPhones, right? Maybe the stock goes up, maybe it doesn't, but there's a particular risk in stocks with this because everyone knows the products that the companies make. So you quite often get stuck in this kind of thinking of, you like the iPhone or you like Starbucks coffee or something, and you have an idea why BlackBerry is a bad phone and therefore you should short it, these kind of things. Well, sure, but these things will not be anything unique, right? It's not going to be any dramatic insights that no one else has, and it's probably not going to help. I much prefer strategies that select the stocks based on completely objective criteria. So I think knowledge of stocks can actually hurt you.
Thanks, Andreas. So the next question is from Mike. He asks, how do you determine the optimal amount of positions to hold to maximize gains while at the same time maintaining a margin of safety that you won't blow up your account?
Well, this blow up account is an interesting phrase. I think if blowing up the account is even within the realm of imagination in your trading style, then something is wrong. Then it's about gambling, not trading. I've never seen a trading strategy on the institutional side that has the potential of blowing up. I mean, blowing up the account, that's, well, let's say there's a major earthquake in a major financial center, who knows, massive apocalyptic events, well, who knows, Mad Max style events, who knows what's going to happen to the markets, right? But barring these kind of things, you shouldn't have a trading strategy that you could even imagine could blow up the account. Then you're taking far, far too much risk. Optimal amount of positions, well, number of positions, it doesn't really matter. It's about the risk you place on the portfolio as a whole. That you need to keep track of course. But of course, if you aim for a few 100% a year, you might have to take a risk that you're going to blow up the account, but it's not something I would recommend, and it's very far from what I do for a living.
Yeah, okay, sure. So the next question is from Sean. He's got a backtesting question. Do you use the whole data sample to backtest over? So it would be all in sample or not?
Well, with this kind of models that I'm showing here, you don't have to do it this way, or at least I don't do it this way for this kind of models. I start up with concepts that I know works, something that I have been trading for many years. I start out with a reasonable version of a broad concept that is very well known in the market. In this case, the momentum effect. I show a variation. Numbers are picked more or less, I wouldn't say at random, but numbers are picked based on what makes sense, what I want to accomplish. I want to have medium-term momentum strategy. I need to make sure I have positions that behave a certain way. I don't want to have too high gaps because, well, gaps make me nervous for various reasons. I start out with things that make sense. I show the strategy. I show that it works, and I vary some parameters of the strategy, and show how does it change, what parameters are different or not. What I don't do here is run optimization on part of the data set and do a walk forward to see how it works on the remaining data set and so on. It's not that kind of strategy that I need to do that on. I show a broad concept, not an over-optimized model on a certain data set. So
yeah, I did notice. I did notice towards the end of your book that you did test some other parameters just to ensure that the strategy that you're using was robust.
Yeah, exactly. I just wanted to show which parameters matters, which ones can be changed, and the results stay more or less the same. And frankly, in the end, I don't care if you change some parameters and the annualized return goes up or down a couple of percent. I wouldn't go changing anything because of that, because it doesn't necessarily mean anything about going forward. If I do some dramatic changes on some parameters, I see that the end numbers change by a couple of percent, well, that probably means these numbers weren't really relevant in the first place. It doesn't really matter. They're more or less in that area, and yeah, let's keep them more or less in that area. To think that you're going to get much better results in the future because you get 2% higher annualized return if you tweak some variable, well, that's not very realistic. That's why I'm insisting that you should trade the broad concepts. Find concepts to trade and not over-optimized models.
Yeah, that's some great advice. Thanks, Andreas. Another question from Sean. Mm-hmm. Do you use Monte Carlo simulations when running backtests? And if so, what is your procedure for doing so?
No, I don't.
No. I don't think he's read your book yet, so he's not aware of the ranking that you use.
All right.
And his last question was, are you interested in mean reversion strategies for stocks?
Sure. I do run mean reversion models as well. The book does not bring them up at all. I kept the book style clean, only about momentum. But yes, of course, in our shop we trade many different strategies.
So maybe that's another book coming. Mean reversion book.
Well, let's see. No, I mean, this is what I usually point out, that it's very dangerous to view yourself as a trend follower, for instance, because it locks you down to a certain mindset. I just follow trends, that's what I do for a living. It's not a good way to think about the markets. If you want to think about yourself as a systematic trader, for instance, that's a much more healthy approach. If you see yourself, for instance, as a pure trend follower, well, we see what happened to trend followers for a few years, right? I mean, the strategy is coming back, but it had almost 3 years, so it was quite bad. Most CTAs, most major future funds are diversifying into multiple strategy styles. So even with stocks, you have many different strategy styles. It doesn't make sense to lock yourself to any single strategy. There's nothing wrong with mean reversion strategies. They work fine. They actually work very good in They work very well in conjunction to momentum or trend following models. And combining models is quite often a very good way to gain some added diversification, to get higher returns at lower risk by having different style models.
Yeah, okay. Thanks, Andreas, for answering that one. So I'd just like to wrap up with a few quick closing questions. The first one, what's the biggest lesson you've learned through trading?
Probably not to take it personally. I think one thing that takes a long time to learn is to make major losses in terms of money, not necessarily in percent, but to lose large amount of money and still sleep at night. Once you start managing institutional money, the daily swings in terms of actual money, gain or loss, it can be quite substantial. If you're in a drawdown, that might not be worrying from a backtest point of view, for instance, is something that's quite normal in terms of behavior, might be the same as everyone else is losing out there, and you're in line or even better. But still, if you start thinking about how much money was actually lost last week and what does it mean in the real world, this amount, that drives you crazy. You have to get rid of this way of thinking. You have to let it go. It's the same thing, of course, when you're gaining, but, well, then you're too happy to care anyway. It's mostly when you're losing that you start thinking about the amount of money in actual dollars that were lost and what this actually buys.
So how do you personally cope with those type of situations where you're going through a big loss or a drawdown?
It used to get to me a lot, but you have to detach yourself. You have to completely detach yourself mentally from it and start seeing it as monopoly money. It might sound careless, but I would say it has the opposite effect. If you have too much emotional attachment to these kind of things, it will have a negative impact on your performance. Even though this is actually real money for clients and, of course, your own money that's in the products, but you can't keep seeing it as, I just lost another Ferrari today. That's it's a bad way of looking at things.
So what do you think is the most important ingredient to becoming a successful trader?
Well, how about critical thinking? There's a lot of things, you see a lot of things that doesn't make too much sense. It might even be smart people claiming it, but you always have to look at things and reevaluate them yourself and do your own math, your own thinking, test things, listen to everything, make some critical decisions about who to listen to and why, and test what they're saying, try to figure out why they're saying what they're saying. I guess it goes in most areas, most businesses as well. Just critical thinking and don't take anything for granted.
Oh, that's a good one. Yep. What's your favorite trading book?
Nothing my own. No. I would say I have to go back to when I started out. I think Jack Schwager's first couple of books were amazing for me at the time. They gave a lot of insight into how things work. His Market Wizards books, I think, were really good. The first couple of books back in the 90s. I also think, just for fun, just to say something different here, hobby traders should read the amazing book Buy Side by Tony Duff.
Sorry, which book is that?
Buy Side.
Buy Side, yeah.
Buy Side, mostly because it completely smashes the say more romantic view of what trading is and what hedge funds do that many people outside would think. I have to say, disclaimer, I'm in a very different type of hedge fund than he was, but it's he shows a different side of that world, a world that is far too common, especially with the discretionary equity hedge funds. It just shows a very different world of what traders do and how the business works, and it's an extremely brave book, and he's a very nice guy as well, and he's written a very good book on there that I think should open some eyes for people.
Did he lose a lot of customers after he published that book?
Well, he actually wrote the book deliberately to burn himself, to make sure that he could never get a job in hedge funds again.
Ah, that's interesting.
No one would hire him again after he wrote that book. That makes it interesting.
Wow, I'll have to go and read that one. What's the best way for listeners to get in touch with you?
Well, I guess easiest is my webpage, followingthetrend.com. I can be contacted through there.
Okay, excellent. And just before we wrap up, is there anything else that you'd like to mention?
Did I mention I wrote a book? And you can buy it on Amazon.
It's a fantastic book as well. I highly recommend
Thanks.
everyone go and get that. And the previous book, the previous one you've released as well, is also fantastic if you're a futures trader. So go and check those two books out. And Andreas will let us know when his third one is written on mean reversion. So.
Yeah, let's see about that.
All right, well, excellent. Well, thanks a lot for your time today, Andreas. I highly recommend everyone go and check out his website and the two books that we've already mentioned. They're excellent resources, and it's a good way to learn more about trading. So thanks a lot for your time today, Andreas. I appreciate it.
Thank you, Andrew.
What a great chat with Andreas this week. It was really good to hear his perspective on trend following in stocks and various other aspects of trading too. I was quite interested in his comments on risk allocation versus cash allocation, that is, basing position size on volatility rather than using a fixed position size. If some stocks are more volatile than others, but your position size is always the same, your risk allocation would be really random, skewed towards the volatile issues. Position sizing based on volatility aims to get the same approximate risk per investment, so each position should have an equal risk contribution to the portfolio. The other point he really highlighted in the chat was trade a concept. When you trade a concept rather than an optimized model, the details don't really matter too much. In his book, Andreas starts off with a reasonable version of a broad concept he knows works, that is, or in this case it's momentum. Then he tries some variations that make sense or align with his objectives to see how the strategy changes and to check for robustness. He doesn't run optimizations, walk-forward testing, because he's trading a broad concept, not an over-optimized model that works on a certain data set. Andreas summed it up quite nicely with this statement. And frankly, at the end, I don't care if you change some parameters and your annualized return goes up or down a couple of %. I wouldn't go changing anything because it doesn't necessarily mean anything about going forward. But if I do see some dramatic changing of parameters and I see the numbers change by a couple of %, well, that probably means those numbers weren't really relevant in the first place. It doesn't really matter. They are more or less in that area, and let's keep them more or less in that area. To think you are going to get better results in the future because you get 2% higher annualized returns if you tweak some variable, it's not very realistic. That's why I'm insisting you trade the broad concepts, find concepts to trade, not over-optimized models. So those were my top points for this episode. Don't forget to check the show notes where we have additional information and links to his books and other resources. The show notes are available at bettersystemtrader.com/13, so go check it out. Also, a big thank you to all the listeners who submitted questions for Andreas this week. If you'd like to submit a question for future guests, make sure you're on the Better System Trader mailing list, and I'll send you an email when the next opportunity arises. Anyway, that's it for this episode. I hope you enjoyed the chat with Andreas. Thanks for listening to Better System Trader. Catch you next week.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.